Welcome to Alpha Insights. I'm Lucy. Today, we're turning our attention to supermicrocomputer, which recently took a hit in the market. To help us unpack this situation, we have Peter, a market strategist with deep insights into tech stocks and their implications. Hi, Peter. Thanks for joining us.
Thanks for having me, Lucy. Always a pleasure to discuss the market dynamics.
So, Peter, let's dive right in. Goldman Sachs has downgraded supermicrocomputer to a sell rating and set a price target of $26. What are the main reasons behind this downgrade?
Great question, Lucy. Goldman Sachs pointed to profit margin pressures as the primary concern. They highlighted that while there's robust demand for AI servers, the costs associated with producing these systems are rising, which could impact profitability. Essentially, investors are worried that despite strong sales, the company may struggle to keep its margins healthy.
That makes sense. Supermicro is a big player in the AI infrastructure game, so this kind of news can really shake up investor confidence. How did the market react to this downgrade?
The reaction was pretty immediate. After the downgrade, Supermicro's stock fell by about 5.5%. This drop indicates that investors are sensitive to any signs of decline in profitability, especially in such a rapidly growing sector like AI.
Absolutely. It's intriguing how market sentiment can shift due to perceived financial health. So, even though the demand for AI products seems strong, it appears the focus has shifted towards how much profit the company can actually retain. What should investors keep an eye on moving forward?
Investors should watch several key indicators. First, keep an eye on Supermicro's earnings reports and any commentary they provide about margins and pricing strategies. If they can reassure investors that margins are stabilizing or improving, that could be a positive signal. Additionally, any follow-up from analysts could also play a critical role in shaping market sentiment.
So, it sounds like context is crucial here. Even with the pressure on margins, demand for AI infrastructure is still notable. What does it mean for the industry as a whole if companies like Supermicro can't maintain their profitability?
That's a great point, Lucy. If Supermicro and similar companies can't uphold their profit margins, it could create a ripple effect in the industry. Smaller suppliers may lower their prices to stay competitive, which could further compress margins. Overall, this might lead to increased volatility among tech stocks focused on AI, as investors weigh growth potential against profitability risks.
It's definitely a balancing act, especially in such a fast-paced sector. To recap, what are the key takeaways for our listeners today?
Sure, here are the main points to remember. First, keep an eye on Supermicro's earnings reports for insights into margin trends. Second, watch for any follow-up actions from analysts that could affect investor sentiment. Lastly, be mindful of the broader implications of profitability issues within the AI infrastructure sector as it evolves.
Wise words, Peter. Thank you so much for breaking this down for us. It's always refreshing to have your insights on Alpha Insights.
Thanks for having me, Lucy. Always glad to share thoughts on these market developments.
To our listeners, thank you for tuning in to this episode of Alpha Insights. We'll keep you updated on Supermicro and the trends in the tech market. Until next time, stay informed and invest wisely.